Hello and welcome to the real estate market update for May 2023. We will be looking at the numbers posted in April as we move into the summer selling season. My name is Dennis Maynard. I am a real estate broker here in Los Angeles. Needless to say, the market has been behaving pretty much to expectations. Interest rates have moved up dramatically since November. But before we all race off and blame the Fed, let's keep the blame where it belongs. Congress from 2020 through 2022. If you've taken Econ 101, you would have known that inflation would have happened. The Fed had to wait until after the re-election of Jerome Powell to begin to tame inflation by raising rates. The labor market appears to be resilient, and prices are moderating some. CPI is currently at 4.96, with sticky CPI at 6.32. Food and energy are taming some for the moment, but wages are still persistent. This means that inflation is still stuck in the economy as wages attempt to keep up with the higher prices. I've talked about this before, but the Taylor rule is still in effect. The Fed will need to raise rate further to combat inflation. Raising rates is effectively demand destruction. The Taylor rule is currently saying that the Fed funds rate will need to exceed a minimum of 5.71%. This means 2 or more rate hikes minimum. How does this affect mortgage rates and the housing market? Well, mortgage rates are influenced by the 10-year Treasury. This means as the Fed funds rates go up, so do all other rates. I would expect to see interest rates closer to 7% for the 30-year mortgage by the end of summer. It is important to keep a historical context. The average rate for a 30-year since the 1960s is roughly 7.5%. So this period we're going through is more of a normalization. If we see inflation rear its ugly head further, as in the 1970s, expect rates to really move higher. The national housing market has been slow. The number of new listings is down. This is keeping inventory down and supporting prices. Prices are pulling back in some areas, but it's relative to affordability. Less affordable areas are seeing more price declines as more affordable areas. This is why we continue to see prices hold and rise in the east and fall in the west. And the national median home price fell 1.7% to $388,000. Now, this is boosting the numbers across the country, which would otherwise have been lower due to falling prices in the west. Existing home sales in April fell 23.2% from 1 year ago and have declined for 14 of the last 15 months. Delinquency rates are still very low. As shown here, the number of delinquencies has stayed pretty much flat across the country. The reason for this: people who got homes got them at a cheap rate and can afford the payments. Hence, no defaults. In Los Angeles County, new listings, active listings, pending sales, closed sales all remain near 5-year lows for both condos and single-family homes. The median sale price for a single-family home in LA is $880,000 in April. This is down 11.6% from a year ago. The median sale price for a condo in LA is $650,000, down 6.5% from a year ago. It is incredibly important to keep perspective at a time like this. Most people who bought homes over the last couple years did so because they could afford them. Most homeowners are now rate locked and can't get a new loan at the rate that they previously had. This means fewer owners will be selling into the future. Will prices adjust to the new realities of higher rates? Yes, but I do not expect a crash in housing, and I've been saying this for over a year for this very reason. Is it a good time to buy? Yes, there is less competition. This offers you the opportunity to take advantage of the pullback. If your intentions are to buy a home and live in it for 5 or more years, it is a good time to buy. If you're looking to flip houses, I do not recommend it unless you are getting a really deep discount. If you need help buying, selling, leasing, investing in real estate, please reach out. My team is ready to help, and I'll catch you on the next market update.